Good afternoon. Thank you, Mima. Always a great pleasure to be working with our friends and partners, IGD. Distinguished guests, ladies and gentlemen, good afternoon. As Mima mentioned, my name is Hubert Dan, so I'm the CEO of Africa Investor and the chairman of the African Sovereign Wealth and Pension Fund Forum and the moderator and chair for today's session. This particular roundtable dialogue is going to feature a real process and discussion on institutional investor-public partnerships. And the dialogue is going to be led by policymakers, institutional investors, development finance leaders. And the focus is really going to be on really trying to get granular around the products and the policies and specifically the role of development finance institutions and how they can facilitate more allocations from global as well as domestic institutional investors, not only into Africa, but also into African infrastructure as an investable asset class. So we're going to commence this session. You can see that I've got a very small panel. Sorry about that. So everyone's going to get extra time. But I'm going to break this session up into the way that it's structured in the program that you should hopefully have in front of you with some opening remarks. And then there's going to be an extended investor discussion that will be focused just on our institutional asset owners that are with me on the panel. And then we're going to have our opening speakers from the African Development Bank and NEPAD come back and just give us their views on the comments that they've heard and the recommendations, and then just really talk about next steps and the way forward. And they have some very exciting things to share. I think most of us, experience in many cases conference fatigue. And it's not just conference fatigue because you go to a lot of conferences, but it's conference fatigue because you're sort of talking into a bit of a vacuum. It's as if we sort of come and share views that we sort of talk amongst ourselves, but we don't really know whether they're going to be taken up or acted on. Well, I can assure you that this is very different because today we have the African Development Bank that is playing a great leadership role and committing significant resources to really taking on board some of the recommendations that will be shared here today. So no vacuum there. And then the next thing is we always talk about, well, okay, it's great for a multilateral or a development finance institution to pursue an agenda, but where's the political and public sector leadership? And there I can assure you, once you hear from Shamir from NEPAD, he's really going to make clear that this is really linked into a heads of state supported and driven process. So, I mean, with that said, there's real and great impetus for this dialogue. I think we all know what happened at the G20 meeting where they focused on the Africa Compact and mobilizing institutional capital for long-term assets. The real issues that were thrown up by Basel III and Basel IV on the availability of project finance. And as I just mentioned, and critically, we're seeing increased continental leadership through the African Development Bank's High Five agenda, the African Union's Agenda 2063, and NEPAD's recently launched 5% initiative. I think what the sort of, the thread that ties all of that together is that they all recognize an urgent need for a new, structured and distinct special engagement and working relationship with real catalytic domestic and international institutional investors and asset owners. Who are we really talking about? Pension funds, sovereign funds, reinsurance institutions that are not necessarily the regular participants at events like this. It's a very specific community, and when we all congregate here in Washington or when we congregate in New York during the UN, it's sort of a very well-defined development community. Private sector, development finance institutions, governments. And I think what we believe is the sort of missing link is the full inclusion of the institutional investment community into that discourse, particularly when the SDGs, a number of the overall development agenda, is driven by significantly large investments into long-term assets. So to open up this particular panel, I'm now going to call on our distinguished partner and supporter, Pierre Gosselin, who's the Vice President for Private Sector Infrastructure and Industrialization from the African Development Bank, as well as Shamir Gray Johnson, who's the Head of Regional Integration, Infrastructure and Trade at NEPAD, to make some opening remarks. And I'd like to call on Shamir first. Thank you.
Thank you very much.
Shamir, just share with us the 5% agenda and what the process is. And
Yeah, I was actually going to give a short presentation, but before I do that, thank you, Hubert. Thank you for having me. I thought maybe I'll just give a quick background as to why we came up with the 5% agenda, so that the participants and colleagues will appreciate the seriousness of why we need a 5% agenda. Just backtracking 5 years ago when the Program for Infrastructure Development in Africa, PIDA, was endorsed by the heads of state, there was this euphoria and excitement that the next day we will have so much private money accompanying public money, and the 433 projects will be implemented by 2020. We are now in 2017. We have 3 years to go, or less than 3 years, and not many PIDA projects have been implemented, and we have not been able to attract private financing to get these projects implemented. So 2 years after 2012, we went to Dakar. We had the Dakar Financing Summit, and then we found out that money wasn't the problem. It was really poorly prepared projects. So from 2014 to present, we've really doubled or redoubled our efforts to make sure that these projects are well conceptualized, that there's project preparation funds for it, and we are beginning to package projects which should attract private capital. But then last year, based on the work we did with Africa Investor, the African Development Bank, the United Nations Economic Commission for Africa, and of course the African Union, the work we did on de-risking projects, we found out that there is need for institutional investors and institutional players like pension funds and sovereign wealth funds to also participate in the implementation of transboundary infrastructure projects. So out of that process, we came up with the 5% agenda. And the agenda, it's very, very clear. It's an agenda that we were very serious about. It was launched by the new chairperson of the African Union, so we've pitched it at the highest political level. And the idea is to make sure that the communique that was finalized last month here in New York, no, we in Washington actually, not in New York, during the United Nations General Assembly, that communique, that business communique that brought together a number of pension funds, a number of public players to agree that we needed to do something about getting institutional investors put money into Africa's public transboundary infrastructure, so to speak. So these are the timelines. We are hoping that by the time we get to January 2018, the consultation today being one of them, and the advocacy and also reaching out to select heads of state and reaching out to select finance ministers, which we are doing, we will be able to announce that at least 10 to 12 African countries are ready to commit to this 5% agenda. And I'll just give quick highlights of what this agenda is all about. As I mentioned before, we've tried to fit in the agenda into the work that we're doing as a continental body, of course, together with the African Development Bank. So the agenda fits squarely into moving projects from the preparation to, from the quick and diagnostics and with the SDM to the preparation to the continental business network and all the way to even considering getting pension funds and diaspora bonds issued. So we are using what we call the Continental Business Network, which is a platform that brings together both public, high-level public decision makers and private sector players like CEOs and chief executives that are involved in construction, in project development, and so forth, and also the MDBs and the DFIs to really look at the project and move it forward. So the 5% agenda really complements the work that NEPAD's doing. But just to highlight some key sections of the communique. It's a 15-point communique, and of course all 15 points are very relevant and very important, but it will be important for us to just note point number 7, 5, and 6. Point number 7, which really underscores that we need to be very serious and be committed to making sure that on average, the 1.5% investments in assets under management should be increased to 5%. in the next 5 years. Of course, different countries, 54 countries in Africa, different countries have different legislations and different regulations to allow for pension funds to invest. So we understand that. But the idea is to get the coalition of the willing, the 10 or 12 countries, through their finance ministers, through their heads of state to commit to this. And we can start monitoring and really working with them to get to that 5% in the next 5 years. And point number 5 also talks about that this agenda will reduce and make an impact on the huge figures that we are all aware of in terms of the infrastructure gap in Africa. And point number 6 really talks about the need for reform, the need for regulatory reform, the need for institutions to be allowed to invest in this agenda. I mean pension funds. And then just to sum it up, if you look at the last point here, that the initiative offers benefits to all stakeholders. So we pitched it at a win-win kind of arrangement, where heads of state that have a mandate in most African countries to deliver to their citizens will be able to see how best regulation can be changed to allow their pension funds to start looking at transboundary infrastructure. So of course, we take on board all the other issues, making sure that there's affordability and reliable infrastructure and there's budgetary discipline. So it's just not done in a euphoric moment, but it's done with precision. It's done with making sure that the budget officers who control budgets and make sure that investments are done properly at the finance ministries take the necessary steps to make sure there is a responsible agenda, committed agenda that the heads of state can really push towards. So I will stop there for now, and I think as the discussions go, as we progress, I will share maybe in the concluding remarks what are the next concrete steps, like very concrete, that we hope to achieve in the next 3 months, and how quickly we can get the ministers of finance in their meeting in March to at least put their hand up and say, country X, Y, and Z are ready to go through this 5% agenda in the next 5 years. Thank you very much, Hubert.
Thank you for those opening remarks, Shamir. And again, as Kwame Nkrumah once said, seek ye first the political kingdom. So, we applaud your work, and we know that, at the top and at that level, it's complicated, but I think you've definitely put some very solid foundations in place. Now, of course, none of this can happen without a development finance institution that really understands and works on a regular basis with both the private sector, as well as the governments, as well as institutional investors, really having its ear to the ground in terms of what type of instruments, what type of policies need to be put in place to actually advance some of these transactions. So I'm glad that we have a great and long-standing partnership with the African Development Bank and the personal leadership of Pierre, who I'm going to ask to speak now, in terms of, Pierre, we'd really just like you to share your views on this agenda so that people can really get a sense of the importance from an African Development Bank standpoint, but also to the overall opportunity that this represents, taking account of the sort of the global agenda that came out of the G20. But then when you drill down, you've got the Africa Compact, you've got the Agenda 2063, and the high fives. And I just want to put my hands up now. There's no conspiracy with fives. I think we've got 5% in 5 years, and we've got the high fives. But I'm sure Pierre will expand on that for us. Thank you.
Okay. Thank you. Good afternoon, ladies and gentlemen. It's a pleasure. That's all now. Good. It's a pleasure to be here this afternoon. So I'm here mostly to listen to the institutional investors we want to attract to Africa. So I'll try to be brief in my framing remarks. So basically, the African Development Bank is Africa's development bank, is an implementing and financing agency. So what we're interested in, what will it take for institutional investors, whether they're overseas or African, to increase their exposure to African opportunities, in particular longer-term infrastructure projects, but not limited to that. And in that context, what is it that we, African Development Bank, but also other development partners like IFC, for example, can and should do to help create the right environment and making these opportunities more attractive and more suitable to the specific needs of these institutional investors. So African Development Bank, we have many strengths. One of them is to operate both on the public and private sector side. So we advise governments, we lend to governments, but we also invest in and lend to private companies. We have a big private equity portfolio. We lend to companies directly, as well, of course, as lending to governments. So we can help both on working with governments in establishing the enabling environment that will make it more attractive for institutional investors to come in, again, whether they are overseas or regional investors. And we can accompany these investors through our financial products, risk mitigation products, and others. But so for us to increase this very thin stream of current investment, whether they're the local, again, or the international institutional investors, we need to know what do you need from us to make this more investable. So the type of activities that we would typically get involved in this space, and we work, of course, on many other development agendas, is helping establish local capital markets, which in the infrastructure space is clearly important. We help with local currency bond markets. There are also only about a handful of countries in Africa today that have these bonds, and we provide both advisory services. We have the African Financial Markets Initiative, that is developing also, trying to help develop yield curves for African bonds, and where we have the AFMI Bloomberg African Bond Index, again, to develop this asset class more generally. So there's a whole agenda of our work that focuses on developing local capital markets, which is probably not the main focus of today's discussion, but yet it's a very important one, in particular also for this long-term finance agenda. As I mentioned, we also provide kind of guarantee instruments, including we've provided a partial credit guarantee for Cameroon's 750 million euro bond issue, which got the African Banker Debt Deal of the Year last year. So we have these instruments. We also help the Tanzania Mortgage Refinance Company, again, by using our own AAA rating to give them the regulatory clearance to have a bond issuance in Tanzania. So there are lots of things we can do. And those examples are very specific ones, how we help specific financial institutions access these markets. What we really want to listen to and hear from you is what is it that you would want from us and other development partners, because we're not the only ones in this space, to make it easier, more attractive for you. What are maybe some of the lower hanging fruit? Let's not get the most difficult deals first, and how could we work together on this agenda? And in that context, I mean, I mentioned already the fact that we invest in about 40 PE, private equity funds. The private equity model is not ideally suited for long-term infrastructure. So what do you see as opportunities to build on it or expand on it and kind of generate longer-term financing? Finally, we have, and you may have heard President Adesina mention it on a number of occasions, we are launching the Africa Investment Forum, and Patrick McGee, who sits behind me there, is our point man for that. So if you're interested in the Africa Investment Forum, to go live in November 2018, what we want is not just have one more event, because there are lots of events in Africa and elsewhere in the world, but is to have a real platform where we can help investors and investment opportunities come together by providing a framework and also by using our abilities and kind of leveraging capacity with governments who are not only our clients but also our shareholders. So we want to use this Africa Investment Forum as a really powerful platform to bring investors and investment opportunities together, including by removing whatever bottlenecks may exist for those things to flow and for those flows to increase. So I'm really keen to hear what our colleagues have to say on this panel. Thank you very much.
Thank you, Pierre. Clearly extremely busy, and happy to see that you're prepared to continually open your mind to new opportunities and new ways of doing things, because the market is moving extremely fast with the intervention and intermediation of technology. So I think when we move on to our panelists, we're really going to be looking at and hearing some very different perspectives and solutions. But from Africa Investors' standpoint, we really believe in the strength of data and then how that can come together with technology to meet this massive information deficit. I think when we were having our briefing session just now, just, you know, the different types and natures and forms of pension funds and their rules and their criterias is quite a myriad of, you know, things that we have to negotiate just to understand if there is an opportunity or not. So we at Africa Investor have taken the initiative, I think pretty much a complementary stance to what the Africa Investment Forum is doing, and we've launched, you know, ultimately a platform that brings together institutional investors, private equity players that have interest in infrastructure, as well as project developers, as well as the key data that underlines and informs the investment decision-making process. And that particular platform is called AI Asset X, so Africa Investor Asset Exchange. And I think my colleague might just be able to give you a 60-second insight into that.
Partners and projects is the single biggest challenge for institutional investors seeking to allocate to Africa. AI Asset X is a marketplace designed to securely connect accredited institutional investors and aggregate the capital introduction and raising process for infrastructure projects, private equity funds, and investment managers working in Africa. Investors, project developers, and fund managers can simply apply for registration and are vetted by AI ratings. Once approved, they are listed on the platform and can post specific investment mandates, co-investment opportunities, projects, capital raising requirements, and immediately identify qualified partners. AI Asset X provides unique access to investable assets, investment strategies, secondaries, data rooms, research, and institutional co-investment partners.
So that's a small contribution from Africa Investor that we're launching here today. But I know that there are a number of other initiatives and ideas that a number of our panelists that are joining us will be sort of sharing in terms of their valuable insights and ideas and on sort of instruments and approaches both heads of state can take as champions of this agenda and the ADB can take to develop policies, products and instruments. So I'm now going to introduce our panelists who are the investors. So we have Ibrahim Khan, who is the CEO of FONSIS, the Senegalese Strategic Sovereign Fund. We have Gavin Wilson, who is the CEO of IFC Asset Management. Chuck Burbridge, who is the Executive Director of Chicago Teachers Pension Fund. Joshua Franzel, who is the President of the Center for State and Local Government Excellence, who represents retirement funds from across the country. Nick Fursley, who is the Director General of the World Pensions Council and a board member of the World Bank Group's Global Infrastructure Facility. And Ian Cameron, who is the COO from Washington State Investment Board. So I'm going to go straight into this in the interest of time. I'm going to call on you, Ibrahima, as an African asset owner, working with DFIs, working extensively in the infrastructure space, to really just share your views on the emerging institutional investor public partnerships agenda and, you know, your recommendations to development finance institutions and heads of state. I think your own head of state is one of the Presidential Infrastructure Champions Initiative leaders, one of the few presidents that are really pushing the private sector agenda into infrastructure. So Ibrahim, please share your views on, you know, what our partners in the public sector and the DFI world, as well as asset owners, can really do to push this agenda.
Thank you very much. FONSIS is, let's say, a small AFDB mixed with private equity in Senegal, a small country. That means I'm going to talk very micro. And from this perspective, give some, let's say, feedback to you investors and asset managers. I would like to congratulate AFDB and NEPAD first for this, let's say, opportunity that they are giving to us. A lot have been done before to attract private investment in Africa. A lot have been done through, let's say, guarantee, security, let's say, closing deals. How to ease deal, how to make deal close through, let's say, all these guarantee and securitization systems. But today, the issue is not how to ease this deal closer. Today, the issue is how to increase the deal flow. Not all pension funds are going to invest in Africa, but how to attract most of them, how to give them a portfolio of assets where they can invest in. And what we see today is, in terms of recommendation for DFIs and head of states, is to go for an alignment between DFI's agenda and push them. It will be a head of state that will do the move, push them to initiating projects, having pilot projects and developing projects, and attract investors and then asset managers to refinance projects. Because today, the gap is there to how to increase the deal flow. And as an example, we are currently developing with the AFDB, let's say what we can call a junior debt fund for renewable energy and energy efficiency. We did a small market survey in Senegal, and we see that this market is about $500 million US. It's a small market. However, when we approach the investors, they say, okay, we don't know the market. We need information. We need liquidity. So what we decided is we put a first layer of money to develop the pipeline and develop a portfolio of assets, and then go back, address the domestic market, domestic capital market, because otherwise, without this domestic capital market, there will not be any liquidity for you to come and invest, because at some point, you need to have some liquidity on the market. So this will be the second recommendation, develop domestic capital market. These are the two, let's say, legs where we need to, what we need to use to have you people be comfortable, right level of deal flow and liquidity on the market that will give you, let's say, the right level of information and the exit possibility that you need to come and invest. This is what from our small experience, being a strategic investor, also an asset manager for the state of Senegal, this is what I can contribute today.
Thank you, Ibrahim. I just want to stay with you just for one moment. One of the other issues that we continually hear from asset owners on the continent is the opportunity as well as the need, sort of crossed with the absence of a secondary market for infrastructure investment, and the fact that perhaps African asset owners could potentially play a leading role. Now, that's caveated on the understanding that the secondary market, offers a lot of opportunity for development finance institutions and regional development banks who may need to refinance and recycle some of their assets on their balance sheets. Is that a priority in your view? Is that a view that you agree with?
It's absolutely a priority. I believe that, for example, AFDB, they have, let's say, a good quality portfolio. They are not, perhaps they might take this opportunity to trigger and initiate this move, developing the second market. And this is about building alignment between DFIs, and if you take both DFIs and states, African states, all of them, they have a good portfolio of projects and assets that can trigger and initiate this secondary market that is absolutely necessary, both to develop local domestic capital market and attract investors. We need to have this, let's say, positive loop initiated using these two main players that are the states and the DFIs.
So I presume that would address the issue of there aren't enough bankable projects in the market. we can't take early stage greenfield risk, and we really want to start with post-construction cash generative assets.
Just going back, because today, if you look at our project, you have good yield. Our toll road project in Dakar, I would say, is above 20% yield for 25 years. You have good yields. Why? Because there is a premium to the pioneers. So these type of assets can be available in our region because of the scarcity of capital. So there are big opportunities there. Now the issue is people have high risk perception because they don't know, or even no risk perception because they don't know absolutely anything about. So we need to initiate the move, and using this local capital market that will show to others these are the information, and show out some transparency on the assets, and give some indicators that you will need to take your decision. These indicators doesn't exist at the moment because there is a scarcity of information because of the capital market is not running efficiently at the moment.
Thank you. So Gavin, you're with a DFI that's focused on the private sector, but ultimately you work near exclusively with institutional investors because you're with the asset management team, and you lead that at the IFC. So sort of share with us your view on institutional investor sort of public partnerships, because it's always sort of perceived to be this call that, where there's a traditional PPP type project, when it sort of runs out of cash, the presumption is, well, long-term asset owners have significant assets, perhaps they can be topped up, without sort of realizing that there is a very specific set of criteria that needs to be pursued to be able to even consider investigating the possibility of investing in those assets. And then secondly, I'd just like your view on the 5% agenda and what you think asset owners on the continent could potentially put in place to be able to achieve a 5% allocation to African infrastructure in 5 years.
Great. Well, Hubert, thank you very much for having me. So, Hubert, thank you very much for inviting me. And first of all, I should say I agree with everything that's already been said. So, yes, we need to develop good projects. I think a 5% target for institutional investor allocation to infrastructure is great, not just for Africa, by the way, but particularly for Africa. I absolutely agree that we need to have creative intermediaries such as sponsors who can look at things strategically and bring projects and capital together, and the whole sort of ethos behind NEPAD, et cetera. I mean, so I agree with all these things. Why have we, as IFC, created an asset management company? So as an asset owner, why did we feel that it would be useful to be an asset manager as well? Well, firstly, because we realized that, we have a limited amount of capital, and the way that we could have more impact and to make more projects happen was to also mobilize additional capital. And there are a number of ways of doing that. One way is just through debt syndications, which we've done for 50, 60 years. But we felt that particularly on the equity side, the best way to do this was to set up our own fund manager with a classic GPLP structure where we attract institutional investor capital. We've now, been doing this 8 years, and we've gone from kind of zero to now just actually, as it happens, last week crossed the $10 billion mark in terms of assets raised. This is 58 investors across 13 different funds. So it moves the needle a little bit, but it's mainly the demonstration effect of what we're trying to do is to show that a multilateral can be a financial intermediary and do so on a kind of proactive and profitable basis. And so one of the things that we've been looking at very much at the World Bank Group over the last couple of years as we think about, renewing our strategy, et cetera, is, what are the different ways we can do this? And I'll give 3 examples. Maybe one platform, one product, one policy. And so the platform is the asset management company. And what we have found in speaking to, because obviously we've spoken to lots of institutional investors who said no thank you, and we've luckily spoken to a number who've said yes, we're in, we'll invest. And it's a gross generalization, but what I would say typically is that people have not said we need more return. They've typically said we need less risk. So yes, of course, everything is a risk-return trade-off. But generally speaking, there is a perception that investing in developing countries, particularly in infrastructure, where all the capital is invested up front before there's a single unit of revenue, is how do we, get comfortable? Okay, if it was a listed security, you'd want to see, you'd want to see a triple B minus rating if it was a bond. There are actually very few project bonds, so this is typically, private lending, which isn't rated, but that's conceptually what institutional investors are looking for. Now, one of the ways we found of doing that, aside from the asset management company, is in what we call our managed co-lending portfolio program. Some of you may be aware of this, and where we've tried to package together a series of infrastructure loans. And if, a typical loan that we make might be rated single B, I mean, typically they're a bit better than that, but let's just stick with this concept for the moment. If a typical loan might be single B, you package them together into portfolio, you can get maybe a double B, effective implicit credit rating on the portfolio. And then if we are able to provide a little bit of first loss protection, we can get it to triple B. And so this is what we've done with our MCPP infrastructure program. We've got 2 or 3 large insurance companies who are investing in this. And effectively, we've tranched the cash flows. And we and one other partner have taken, in a sense, the junior tranche. We feel very comfortable with that because we're the ones underwriting the loans. So we think this is very fairly priced. But it makes a huge difference for the insurance companies who could not invest in the package without tranching, but are very happy to invest in the senior tranche because we've provided this implicit. So this is an example of real risk mitigation. There is another type of risk mitigation.
Gavin, I just want to jump in here very quickly. Could or does that apply to projects that are pre-construction? I mean, everyone's talking about how do you crowd in long-term capital to address this early-stage risk deficit. Do you think this model could apply to that, or does it already apply to that?
The model implies completely to that, because what we've done is attract them into not an existing portfolio. By the way, I think there's a quick win in just recycling some existing projects, but I mean, that's a one-off. Yes, of course, we should do that, but it's a one-off. What matters is getting the new capital for the new projects in the future. And so all of this, what the insurance companies, and there's no reason why pension funds couldn't do it as well, but it seems to have appealed most to insurance companies so far, what they have bought into is a future portfolio. So they're relying on us to underwrite it over the next X years. So they don't know what they're buying. What they're buying into is our underwriting process and our risk mitigation. But that requires real structuring and real risk mitigation. There's another aspect of risk mitigation, which is just dealing with the perception of risk, which is much cheaper, okay, which is just getting the message out. Moody's have done an analysis of 3,000 loans to infrastructure projects around the world. It's a bit dated now, as they did it 2 or 3 years ago. And they found that those projects in developing countries did not have a higher default rate than the projects in developed countries. And so actually, as it turns out, post facto, the risk was not greater. Okay? So one of the things we try to do is just get the message out that there's a perception of risk which doesn't necessarily apply. And the final thing I'll say is that country risk, regulatory risk tends to be uncorrelated. So for people who really care about reducing correlation across their portfolio, and we've seen what the problem is of correlations moving to 1 during the financial crisis, this should be an attractive asset class, particularly if you diversify it across very many countries, as opposed to what most pension funds and insurance companies do is they focus on a small number of, either a small number of very large infrastructure projects or a small number of countries, rather than a large number of investments that are spread across subsectors and spread across different countries. And that, in a way, is how you get real portfolio diversification. And I think that would be a way of reducing the risk.
Thanks, Gavin. I want to stay with you just one more second as well. So you've managed to engage institutional investors. Some have said yes, some have said no. You've employed some fine mastery in terms of product structuring, and you've been able to address one of the age-old challenges on the continent, which is how do you move long-term capital into early-stage infrastructure. But I'd be interested to hear your views about, what policy changes do you think we're here right now during the World Bank annual meetings. Ministers of finance from all around the world are here. What would your message be to them in terms of how they can create a more hospitable regulatory environment to crowd in more pension fund capital into infrastructure, based on your experience?
So, Hubert, as I think you're aware, I'm a member of something called the Business and Sustainable Development Commission, which was set up after the UN Sustainable Development Summit a couple of years ago. And basically our job on this commission was to try and make the business case for the SDGs and the SDG case for business. And as we got into this, we realized it wasn't just business, it really was finance as well. And so part of it is awareness, okay, and a need for business and finance to be aware of what the opportunities are. And we calculated a $12 trillion opportunity for those companies who help make the SDGs a reality. But we also realized there was an advocacy role for us in terms of speaking to governments. And you mentioned the G20 earlier. One of the specific things that has emanated from the G20, which will be 10 years old next year, is the FSB, the Financial Stability Board. And that's been quite a useful forum for talking about different financial regulation. And one of the things that we've perceived is that well-meaning, well-intentioned financial regulation in developed countries, Fed, ECB, Bank of England, et cetera, a lot of really good regulations on financial stability, anti-money laundering, CFT, so on and so forth. But the net effect has been to reduce the flow of capital to developing countries. And so we're wondering whether we understand why, if your job is financial stability in Europe, that's what you need to focus on. By the way, there's also Solvency II as far as the insurance companies are concerned. But maybe these regulators should be given a mandate by the FSB to at least think about the consequences for capital flows to emerging markets, because we've just signed up 193 different countries to the Sustainable Development Goals. We've all agreed these are our global goals. So we should at least try and be joined up in how we set aside. So I would say the kind of what I would call the supra-regulatory system, or kind of the regulatory decisions that cross borders, should be looked at very carefully. I think that will have an obvious sort of positive effect. I mean, we see all the correspondent banking relationships getting reduced. That is bad news. We're going backwards on some of those things. So I do think that that is one area. And then the other thing we've looked at is we hear, we happen to have an insurance company on the commission, so we've spoken to them a lot, and they've said they would like to invest in infrastructure because they have long-term liabilities, so they need long-term assets. But the trouble is, a lot of regulations make it difficult for them to invest more than, 1 or 2% or whatever. And so I said, I posed the question. I said, well, if the regulation was turned on its head, and the regulation said you have to invest at least 5%, as it happens. I mean, I didn't know about your 5% agenda here. At least 5% in infrastructure. I mean, would that solve your problem? So is it purely a regulatory problem? And then they go, oh, God, well, in that case, I guess we're back to our old friend, okay, where are the projects going to come from? So we can't solve this on one side, only. We have to do both, okay? It's not either or. We've got to increase the supply of capital, partly through showing the risk is less than it is, and partly through really mitigating the risk. And at the same time, we've got to make sure there are good projects to invest in that have all the complexion that you need from a long-term asset that you're investing in order to ultimately pay pensioners or life insurance policyholders in 20, 30 years' time.
Absolutely. I think those are, the real sort of key, the key issues here. When we engage the regulators, well, listen, as far as we're concerned, perhaps the asset owners are overly conservative. Because we are not trying to prevent allocations into infrastructure. So maybe it's a overly conservative interpretation. The second thing they said is, we do not make regulation. We simply oversee its compliance. So if you really want to change the game, then you should be engaging with the ministers of finance that actually make the policy. And in terms of your, the creation of your bankable pipeline of projects, most of them are responsible for the PPP units and the development of letting and bringing infrastructure assets to the market. So I think there's some work to do there, but it's good that. So
one quick PS, if I may. I see we have Philip Moss over here with SDIP, and one of the things we also need to do a good job of is creating more of a marketplace where we don't have projects over here and capital over here. We sort of bring them together. That's part of the role we should do a better job of. It's part of what the forum is doing with SDIP, and it sounds like it's exactly what you're doing also with the African Development Bank and NEPAD, et cetera. So that bringing together, creating the market where you can connect projects and capital is, I would say, is a key objective.
So, I mean, we've identified some opportunities and some constraints from within the continent, but I mean, you've talked about the trillions of dollars offshore. So I'm now going to turn to Chuck, who I'm sure forms a component of that, and he's been working very hard and over a long period of time to better understand Africa with us. He did a trip to South Africa earlier on this year. Chuck, if you can just share your views about where you are in your sort of process about considering and allocations to Africa and African infrastructure, and sort of what challenges you may have and where you see the potential solutions being taken forward, and how the likes of a development bank like the ADB can potentially help.
Okay, I'll try and do that, but I'd like to really kind of go out in the audience. This is fascinating, to hear the panel so far. I'd like to thank ITD. The people I've been meeting here are just really terrific, and some of the ideas that are coming forward are really helping inform my ideas about investing in Africa. But my journey started a couple of years ago in trying to understand Africa as an investment opportunity when I joined the Chicago Teachers Pension Fund. I'm new to the industry, and so but I have a long background in government service and economics, so it really piqued my interest on why we're not invested in Africa. And as I've educated myself, you mentioned, and my colleagues, I should say, we did do a trip to South Africa with NASP. NASP has had a couple of Africa summits. Yesterday I was at Bank of New York having their inaugural Africa summit as well. So there's certainly plenty of information being presented, and yet I listen to Gavin and I say, we've got two ships passing in the night. I think we've talked over the past year about how do you de-risk these investments. What's the investment? Are they packaged, ready to go? We've been introduced to fund managers that help put money to work in Africa. All types of things that have. It's almost like every question I've come up with, whether on a panel or in private, somebody out there has been trying to solve it. Whether it's with the OPIC insurance or co-investing through a multinational organization, and yet what you get down to is you say, how do you get us together, and we're still not getting together. And we started having the conversation beforehand. Pension funds are no more the same as the 54 countries of Africa are the same. And so my situation isn't going to be the same as Washington State's situation. But when you think of the fact that all of my investments are sourced through an RFP, a request for proposal, for a specific mandate that's often carved out or defined by an investment consultant that's advising our board, and the reality of our investment consulting advising the board to say that we should have an Africa infrastructure component in our mandate for our asset allocation, that we're probably no closer to that today than we were 2 years ago. And it's not because there aren't projects. It's not because they're overly risky. It's more about educating our governance model. You know, our trustees are elected from our members. The advisor makes their money by advising more assets under management, and then they basically are paid to not stray too far from the kind of the benchmark. And quite frankly, Africa isn't in any benchmark. You know, it's not in the emerging market benchmarks. It's not in the developing. It's nowhere because there are no public markets really to speak of outside of South Africa, and so it's like we're still not connecting, and way I put it in one presentation was this team. I'm going to say this team, and maybe it's another team on my left here, but the team on my right has done everything to address everything that you'd read about in the Financial Times. I invest based on what my trustees read in the Chicago Sun-Times, which is a much different circle of risk and opportunities than what you're managing to. So I think it was very helpful earlier this year where I was able to get 4 of my trustees to participate in a forum on Africa, and their eyes are kind of like opening up and saying, wow, you know, why aren't we doing this? Because I think they're predisposed to want to invest in Africa. You talk about matching long-term assets to long-term liabilities. Chicago Teachers Pension Fund, we're 122 years old. We're among the oldest pension funds in the United States. We are the oldest in Illinois. We are looking out for the next 100 years on being able to pay benefits to our members. So we have the conversation that the United States was an emerging market at one time, 100 years ago. And so where is that next emerging market? Well, as an economist, I can tell you, well, it's Africa. It's like Montana, the last great open space in America. Africa is the last great untapped investment opportunity globally, essentially. So we know we should be there, and yet our mechanisms from the way we vote on putting money to work, the way we get our advice to put money to work, and the way we receive solicitations are really stacked against investing in Africa. Part of our trip to South Africa, we met with one of the large banks in South Africa, and we asked them, well, okay, you've got these great investment vehicles, you're active throughout the continent, and you want us to invest with you. Well, how are you going to approach us? And they said, well, we're going to use a placement agent to come to you and say, here, invest with us. And I say, placement agents are illegal in Illinois. You can't do that. You have to respond to an RFP, which means that we have to write an RFP. And so we're still not connecting, even though tremendous work is being done to make this an attractive investment.
Thanks, Chuck. Okay, so you've got the trustees who are incredibly influential, driven by your local press, and we're sort of going global on our sort of media perspectives. So you've got that on the one side. And then you have the investment consultants, the classical gatekeepers on the other. And then you have your view in the middle because you sort of travel to the continent. What do you think the DFIs could do? Because, we're involved in a fund that's just been established. They raised $550 million. This was in the last 3 weeks. 3 pension funds led it out of Europe. And they got their trustees on a plane, flew them to the continent, and said, see for yourself. And And apparently that was the difference maker. And then when you speak to some other plans, they will explain, well, you know, we can't pay for travel.
Right,
we won't pay for travel.
We're prohibited from traveling overseas.
Yes. And then on the other side, just to finish off the sort of little circle there, you've got the investment consultants who you pointed out yourself are not motivated to empower or educate themselves, and if they're not motivated to do it for themselves, they certainly won't be for you. Do you think there's a role, because the likes of an Africa Development Bank is neutral, so it's not a fund manager that's looking to solicit any investment from you directly, could support the trips for the trustees and the development of educational material for investment consultants? Do you think that would make any difference, or it makes sense, but it might not be practical?
Well, we would not have gone on the South Africa trip if it were not for USAID partnering with NASP. That's the only thing that made it possible for us to take myself and staff there. And now that we've come back and we've told our trustees about the opportunities, now the trustees want to go. So it's really generating the interest at the trustee level is helpful. I think we talked about earlier, one of the things that I'm doing as the executive director is trying to build out staff investment expertise to reduce and diminish our reliance upon the investment consulting model. Because you talk with them, what risks are they managing to? Where they're managing to their career risk, are they going to keep a job, and to their own economic risk about can they expand their assets under management, and you don't, so they don't stray very far. They're very conservative. If they'd have a tracking error of 1, or if they could have their way. And then diversify all your managers so that you then match the indice. But so I think those are the things. Education of the membership. I would really, it's effective, but it's probably wrong to say that if you put in a mandate. The state of Illinois has mandates for supporting women minority investment managers. Well, that mandate went in, and we went from having 7% of our assets under management, we're now at 38% of our assets under management by women and minorities. Putting in mandates makes a difference. If you want to do it at the state level, it'd probably be a wrong answer. But if somebody said if we had a 5% mandate to invest in Africa, would we do it? Well, yeah, we would, because we comply with statutes. I think education is the key here to demonstrate, and it's probably not just educating our trustees, but as in many cases, it's educating the editorial boards of the local papers and on why these are good things, so that when they see a pension fund going outside the so-called box, that they don't immediately just shoot it down, saying, what the heck are these guys thinking? Why aren't they investing in south side of Chicago, where we have such a need? Why are they going overseas? Because that's the things that our members will read.
Thanks, Chuck. Yes, education is everything, I think. And I want to turn to you now, Joshua, because there's a perception within the continent that this risk aversion or perceived risk aversion from sort of global asset owners thinking about looking at the continent. It's always as if it's a put-off. Yes, well, we have a different risk model, we have a different risk criteria, we've got all these different governance considerations. I mean, you're steeped and you work very deeply and closely with all of these issues from a lot of different retirement funds. Can you just walk us through that sort of landscape and how it impacts allocations to infrastructure and allocations to emerging markets?
Sure. Well, first, thank you for having me. So I'm with the Center for State and Local Government Excellence. We work with states and localities throughout the U.S. on a variety of topics, but one of our main areas is on public sector retirement funds. And for those in the audience who might not be aware of our organization, we manage the largest and most comprehensive database of public pension funds, along with our partners at Boston College and the National Association of State Retirement Administrators, called the Public Plans Database. It's publicplansdata.org, freely available to anyone here and anyone online. So what that database allows us to do is track the state and local sector broadly and look for trends, and especially as it relates to the conversation today. So what are we talking about? We're talking about the state and local pension sector for state and local government employees is about $4 trillion as of Q2 2017. Although there are about 4,000 state and local plans spread out around the country, about 95% of all of the assets under management are within approximately 170 plans that represent, that cover entire states, but then also segmented out in public employee cohorts from teachers to public safety and others. So as it relates to the conversation today, I sort of wanted to talk about 3 points. And I wanted to sort of talk about some nuts and bolts related to coming from a state and local pension perspective. What are some of the nuts and bolts that we all need to keep tracking in order to understand and inform this conversation? One is on state statutes, one is on trustees, and one is on the capacity of state and local pension plans. And Chuck sort of touched on a few of them, but I wanted to go into a little bit of depth about them. The first, I think it's really important for this community and others to really do a deep dive into the state statutes that essentially govern the state and local plans. Many of them are either restrictive or not on the types of investments that funds are able to go into, and may or may not place caps on them. And these statutes are often reflected in the investment policy statements of these plans that reflect not only the state statutes but also the positions of the governing the retirement board and other stakeholder groups. So it might be a moot point looking at investment in Africa or investment in African infrastructure if the state statute doesn't allow it, or the investment policy statement doesn't cover it in some way, shape, or form. So I think it's really important to really know, especially the larger funds, what they're able to invest in, what they're not able to invest in. On the trustee side, before we were having this conversation today, I was looking at some of the training offerings that are being offered to public sector trustees throughout the U.S., and you're seeing an uptick in emerging market training, but you're not really seeing much training at all specifically focused on Africa, and certainly not focused on African infrastructure. So, and these trustees we were talking beforehand are public employees, retirees, elected and appointed officials that are coming from a whole range of backgrounds, but not necessarily investment backgrounds. So I think it's important also to look at the training opportunities that may or may not be available to them. And sort of to your question earlier to someone else, that could be a really providing unbiased, fact-based training on emerging markets, African markets, and infrastructure specifically, I think could go a long way to sort of helping to inform this conversation that's geared towards non-finance professionals that are coming from teaching backgrounds or public safety or whatnot. And then the third point I wanted to raise is just pension system capacity. So when you step back and you look at especially the largest, like I said, 170 plans, the vast majority have a blended approach to managing investments, either 100% externally or a blend of external and internal management. There are a handful that manage all the funds internally. It's certainly not clear to me whether or not a lot of these plans that have internal management capacity have the capacity and internal expertise, I think you were talking about this earlier, to be able to enter into a space like this knowledgeably without really bringing in a lot of additional external expertise. And so I think also the ability to develop internal capacity of these funds to be comfortable with the topics we're talking today, I think is something that also is something that needs to be focused on as well.
That's a great overview. Thanks for taking us through that. And when we look at this whole issue, and I think Chuck's mentioned it, it's almost like a build or buy if you're coming from the tech space. Do we increase, well, obviously, I mean, the key point that we're trying to get at here is that, well, you know, one, we don't have domain knowledge on Africa, you know, within the plan. And then secondly, we don't have the sector expertise to be able to advise on the asset class. And therefore, if we were to advise on an investment decision related to that asset class, then we could be negligent, and we're not really going to put our own careers and our integrity at risk there. So one of the concepts that was sort of put out into the market is, sometimes the plans are not large enough to merit building that in-house capacity. Is there a middle ground where, if we see that this is commonplace across a number of the smaller funds, and it also addresses some of the issues from some of the larger funds, is there some kind of facility that could provide, whether it's DFI driven or whomever else, that could provide a central pool of expertise and knowledge that could evaluate transactions to help trustees and investment consultants be able to discharge their fiduciary responsibilities around, one, investing in Africa, and two, investing in the asset class, as a pooled resource, independent, but high quality information? Do you think that that is something that could work and resonate within the governance world?
I was going to say those entities exist, and they exist throughout Africa, because there are investment advisory firms in Africa that have that capacity, and they're not licensed to do business in the United States. We actually approached one of them and had a conversation about trying to tap in. I still get their newsletters, but they officially can't do any work for us because they're not licensed to do work in the U.S.
So perhaps it's a potential issue of incorporation. So if a facility could be put in a jurisdiction and provide that service and get the appropriate sort of regulatory support, and it could be funded by...
Certainly, because pension funds, at least my size pension fund, we do use specialist advisors for market segments. We might have a specialty advisor for real estate or for infrastructure in that case. So it wouldn't be unknown for us to seek out that kind of expertise.
Nick, coming to you now. Infrastructure, institutional investor, public partnerships, a 5% agenda. You work with pension plans within Africa and around the world. Be interested to just get your views on, the institutional investor public partnership framework and the 5% agenda. And I know that you may have some views on how that could be reciprocated by global pension plans in terms of making some kind of set target around an allocation for infrastructure in Africa.
Thank you, Hubert. And I'm glad we mentioned trustees and consultants, because they play a key role in the overall asset ownership ecosystem. And even if you read the Financial Times, the New York Times, Wall Street Journal, it's often disregarded. So it's the role of board members, trustees, and the role of investment consultants is often overlooked, and it's a big mistake, because they play a huge role. And in economics we call it the age, or in law, in economic law, it's the agency problem or issue. And there is a huge agency issue, and you have to look at the whole ecosystem. It's very important, and at least your trustees, Chuck, may not be reading the Financial Times, but at least you have trustees, and you have people on average, lawmakers and policymakers in the U.S. at state and local level. At least they take trust law and fiduciary law seriously. Sadly, in France, we don't even have trust law anymore, even though we invented it, ironically. And in many countries, they follow the French bureaucratic civil code, Napoleonic legal system, where board members and trustees don't have as much power or influence. And even though it came from French Norman law, we don't have it. It's essential to have trustees, and it's essential to have trustees who flex their muscles and take their obligations seriously, which on average in the US you tend to have. You also have it in Canada and in Australia, and it's no coincidence that if you look at the rankings of public and private pensions globally, the Canadians, the Australians, and the Americans are always ranked amongst the best. And I will argue that it's no coincidence that the two pension powerhouses across all asset classes in general, but specifically focusing on infrastructure as a new asset class, are the Canadians and the Australians, and very often Canadian public pension plans, federal, provincial, state, and local, or Australian public pension plans, and very often they are, these trustees have a legal background, or they're teachers or professors who are trained in trust law, fiduciary law. That, once again, being French and being based in Paris, is really amazing when you see how pension board members work. It's very important. I'm aware of time, so I'll just move very quickly. Just, you know, a few metrics. Like today, and these are all approximate metrics. So, you know, you could say that today we have between 32 and 37. This is 37 trillion dollars of pension assets globally, and I'm excluding sovereign funds, right? So it's purely pension. We can say like 36 trillion. And if you look at emerging markets, it's only 2.5 trillion, not counting sovereign funds, of course. And so if you look at African pension funds, it's probably, you know, 600 or 700 billion dollars. So you see the imbalance, right? But it's very important, even though African pension funds may be small in the greatest scheme of things, it's very important that they invest in infrastructure, essentially for symbolic and political reasons. And here I really want to commend what Francis is doing, because of course Senegal is not a rich country, but the mere fact that that less developed frontier nation symbolically went through the motion of setting up a sovereign fund, and that you're seeing Francis and perhaps the Caisse de Retraite, you know, the small Senegalese pension funds, put a little bit of money in modern highways, train station, airports. Symbolically, I think it's fabulous because it's sending the right message to people like Chuck or Ian, because it's reassuring if you come from far away to see that the locals themselves put their money where their mouth is. It makes a big difference. Very quickly, there's a huge injustice, but you know, life is unjust, in the way consultants and indirectly trustees look at the world, because, you know, for legal, regulatory, comfort reasons, they use benchmarks, indices. And here, I've taken, you know, the sophisticated MSCI, you know, all equity benchmark. The famous MSCI World discriminates against Africa in even worse, worse fashion. So looking at, you know, that MSCI ACW Global World Equity Index, which is supposed to take into account emerging and frontier markets, you only have 2 African nations within the benchmark, South Africa and Egypt. And that African chunk of the global equity benchmark is less than 0.4% of the total. So of course, if this is your benchmark, and if you're really benchmarking your assets using the MSCI, you know, index, mechanically, I would say, you will be under investing in Africa. It's practically mechanical. Now, looking at, you know, Africa's share of the world economy, and these are World Bank stats, it's 4% of the world economy, it's 15% of the world population, and we estimate at the World Pensions Council that in the next 5, 6, 7 years, 10% roughly of the overall economic growth will come from Africa. So really, if you only have 0.5% as MSCI or your consultant tells you to, you are really under-investing, and you're punishing a promising continent which may bring in interesting returns to your beneficiaries. So it's not only charity or being humane or helping the Africans, it's really making money in a part of the world that is growing now faster than average and will probably keep on growing faster than the world average in the near future. Of course, infrastructure is illiquid, highly illiquid, but sometimes you can use the weakness of an asset class and turn it into an advantage. So we saw in the previous slide that for listed assets, and you know, 90, 95, 98% of pensions assets worldwide are invested in listed assets like blue chip equity or bonds. You know, Africa is really penalized, but perhaps by investing in African non-listed assets, we could leapfrog that whole problem, because of course these stock exchanges in Africa, they're not diversified, they're illiquid, they're small. That's why Morgan Stanley punishes them, because there's a lack of liquidity and diversification if you invest in the Johannesburg Stock Exchange or the whatever Casablanca Stock Exchange. If you leapfrog above listed bonds and listed equity right into private equity and infrastructure, just like Gavin and his colleagues have been doing in emerging markets for the past 8-9 years. It could be potentially a different picture, because investing in African private equity and infrastructure might give you a wider level of diversification. And so here, I will argue that the time is ripe for Northern Hemisphere pension funds to invest in infrastructure. Of course, today, if you look at the overall allocation to infrastructure, if you look at your average pension fund, it's only 1.4, 1.5% in infrastructure on average. So it is not much. So if you're asking people to put 1% in African infrastructure in the next 5 years, that may seem that something which is far too ambitious. Of course, if you're speaking to a trustee, I guess, in Washington State, that the first initial inclination would be to invest near home, right? So they would want probably to invest first and foremost in US highways, US high-speed rail, airports, and then later on in Africa. So if you really want to reach that 1% in 5 years, of course it's very ambitious, but it's not impossible. And I would argue it's not impossible, and I'm aware of time, I'm going to just wrap up my argument, for political reasons. Because here, literally 2 blocks from that building, 62 years ago, President Eisenhower came up with the idea of, building massive highways across the United States, which may seem like a commonsensical idea, which is very good for US business. Back then, most of the Republican and Democrats in Congress were opposed to him, and the US Chamber of Commerce, which stood to gain the most from building modern highways and trains across America, was also opposed to that interstate highway. So the White House had to fight for a year to convince its own constituents that building modern rails and highways and airports in America was good. Back then, in 1955, America was like literally, in terms of quality of infrastructure, 30, 40 years behind Britain, France, and Germany, which had gone through the Second World War. So it shows you how the world changed. And it was, I would argue that it's purely or mostly through sheer political will that Eisenhower was able to achieve that. And we have a good example now in Europe, because the Europeans are crying about the migrant crisis. And the migrant crisis in Europe is not only costing tens of billions of euros every year for German, French, and British taxpayers. We also had Brexit in England. We also had the far right in Germany 7 weeks ago, which now controls.
I'm only encouraging you to look to your far left, and you have your last speaker there.
If you just do the simple equation, the cost of the migrant crisis, what they're disbursing annually to lodge these migrants in France, Germany, Holland, is only a fraction of what it would take theoretically for the governments of Europe to help enhance and guarantee more pension co-investment in Africa.
Fantastic. Point well made. Thank you very much. And Ian, just share with us very quickly your journey investing in Africa from Washington State, because just to counter Nick's viewpoint there, and then how you sort of treat your investments in real estate, and if there are any parallels that could be drawn with infrastructure.
Sure. Again, thanks for having me. It's tough to be the 9th of 9. I'm not sure if I should speak faster or say less, so you can just signal me with the hook when you're ready for me to shut up. So I think I would agree with everything. I don't want to repeat anything that's been said, but I think it would be important to kind of give some context to where the Washington State Investment Board is in its process in global investing, and a couple key points in our history that brought us to where we are today. And I would say one of them, Nick just mentioned it, about 12 years ago, we specifically eliminated our home country bias from our strategic investing and became a strategic global investor. And since that time, we are now invested on 6 continents, 74 countries, in 49 currencies, and have about 12,000 holdings worldwide. So we are there. I think it's in a slight contrast to Chuck's situation. So that's why I'd like to give some context again for where we are. The other piece, I'd just say the other key decision that was made at our agency was that for decades now we've had near a 40% allocation to private market investing. That started out in private equity. It's expanded to be real estate and also tangible assets. Real estate and private equity are both active in South Africa and the African continent. Our tangible assets are not just right now, and that's where we would probably likely do infrastructure investing. I do want to talk about, because it was mentioned before, about, so what are we thinking about? And it's not just the offering of assets in terms of trying to aspire towards, untapped alpha, but for us, it's really about how we manage risk. And I'd say it's not only spread across geography, but also over time. And by time, what I mean is we take a very long-term approach, and what we're always trying to think about is, what is the portfolio that we want to have 20 years from now? What does that right portfolio look like? And I would say Africa would certainly be a part of that portfolio and continue to increase in significance for us. I think that when you aspire towards alpha, if you get it right, it can be a huge windfall. You get it wrong, and it's pretty painful. And so that's why we tend to stay away from that. I think it's more cyclical thinking than strategic thinking, and that's where we like to put our focus on, is really getting the strategy right. And I think in a landscape like Africa, what we're searching for are I would call them the pockets of stability in that region, and where we can really believe in the story and make a commitment to an environment that can sometimes be exposed to turbulent change. The speaker before lunch, I forget who the gentleman's name was, he talked about the fact that Africa right now is an economy that's fairly reliant on natural resources, but really looking to transition towards industrialization. That's important to us. I think that sends the continent on a different path. I think that provides opportunity. I also think that it's a challenge for the governments as they begin to expand and grow in their own responsibilities. They exhibit volatility and probably unpredictable behavior. Is that concerning to us? Yes. Is it something we can't deal with? No. We basically expect it, and we mitigate, and we use it as part of our risk profiling when we look at it. So it's not a reason to walk away from Africa. I think it's a reason just to be diligent and focused when we invest there. And preparing for coming to speak to you all here today, and over time, I spend a lot of time with our investment staff. And so I think, in talking to them about how they think about, Africa investing in general, obviously the first point we start with is data, like everybody else, massive amounts of data. But in those conversations, I noticed that it quickly pivoted over to more organic type stories. And they started talking about, what they were learning as they met people, and they spent time with people at all levels, from country, city, community, right down to neighborhood level, and understanding what drives people, what are they after, alignment of interest. I heard one of my fellow panel members mention a moment ago. These are all really important to us, that our strategies are aligned with who we're investing in. And I would say there was probably three main points that came out of those discussions for me, and there were three items were, I would say, or themes, I should say, were patience, pace, and people. And when I think about patience, we know that there's transformation going on. So I don't think that we can really expect stability and transparency overnight. But these are really key points for us. So the continued evolution towards those factors will be very important to us in the future. We've made a strong commitment. We recognize that learning is going to be a repeatable or repeated event that's going to happen for us, and ultimately what it drives us towards is humility. We don't know what we don't know right now, but we realize that it's about getting face-to-face with people and really understanding the investment spectrum in Africa, and that's really where we spend a lot of our time when we actually meet with people. And just before I move on, I just want to give some context for how widespread our investment portfolio is. So primarily, the three countries that we're investing in are South Africa, Egypt, and Morocco. But we also have exposure in Nigeria, Ethiopia, Tunisia, Nambia, and Kenya. So we're quite widespread right now in Africa, which I think is important to note for this conversation, obviously. So I think ultimately patience plays into a long-term mindset. Africa's no different when it comes to that mindset. Speaking about pace, I think that all emerging markets are emerging at their own individual pace, and we recognize the uniqueness of that, and we can embrace that. I think that the emergence is also not set by investors, but rather it's set by the marketplace, and that's something else important to understand that we're taking a note of and factoring into our own decisions. And again, varies by every level. It varies by region, varies by country, city, all the way again down to the neighborhood level of people that we're talking to on the street level. you know, private markets, it's an attractive investable universe for us. We really want to match our expectations of pace with those markets. You know, I think about developed markets and the, you know, blinding speed at which decisions and data is coming at us in that area. Well, that's completely different when you think about private market investing. And we recognize that, and we're okay with that tempo, and we try to match our own investment process to that tempo. It's something else we're thinking about. We really ultimately just want to keep a discriminating eye out. So for both, you know, integrity and quality of the investments is what we're looking at there. And finally, you know, on the people front, this is about investing in relationships today in a region that we believe will be successful in the long term, and that's the foundation for us, is developing those relationships. It's difficult to predict all trends and outcomes, but I think if we can really understand and know the local people and what drives them and what their interests are and what their objectives are, then we can look for alignment with that, and that's really important to us, is making sure we have that alignment of interest. I also think it gives us powerful insight into what's happening when we understand the local marketplace and to that level. And it also buffers us from some of the volatility I mentioned earlier as the markets transform and continue to develop and evolve. So with that, I'll get to the second part of your question, which was around tangible assets. So we have a
if I can encourage you for the high-level version in the interest of time.
It's not it's very short. I'd say that for tangible assets in our strategy there, what we're looking for, as I said, it's finding the right local partners. It's aligning of interests from both an economic, strategic, and a philosophic basis. And then I don't have time to go into the real estate model itself, but to answer your question specifically, do I think that the real estate model could be looked at in terms of the infrastructure investing? Yes. I think there are challenges with that. I think scale is going to be a problem. If you understand how our real estate model works, I think you'd be looking at, as we talked about, the institutional investor space in the United States is not a monolith. They're all individually different sizes and have different agendas and different objectives. I think you have to find ones with the scale to be able to do that, and I'd say it's probably more of an economic scale than anything. And then I think the other piece of that you don't want to overlook, or we don't want to overlook as we look to whether we would want to pursue a strategy like that versus otherwise, is it really requires a lot of hands-on expertise and development of knowledge about what these deals are, how the infrastructure process works. It was interesting to listen to the agriculture conversation a minute ago. That's the level of detail we're going to want to get into and build that expertise before we apply a model like our real estate model.
You mentioned 40% in private markets.
Yeah.
Yes.
So,
yeah, our new asset allocation is actually up to 43.
Fantastic. So I'm now going to call, thank you very much. So we're just going to bring this to a close now with the final remarks from Pierre. And I think, Pierre, the objective was to get the views of the asset owners and institutional investors and those influencing that community to see how it can influence your work in a positive way. So I wonder if you could just give us your reflections and next steps and sort of closing remarks. Thank you.
Thank you very much, and thanks for a very rich panel here. So a few points, and I won't try to summarize everything, but definitely an interesting start of conversation with some of you or continuation with others. And remember, Patrick McGee sits there, so please make sure to get in touch with him afterwards to continue the conversation. But first, one important thing is we need to work with the African institutional investors, and we have Fonses here, but we already work with PIC and others. And I think one of you mentioned that it's important for a signal to come from Africa, that Africa itself is investing in Africa. So for us, that's going to be an important stream. Two, a number of you have invested in infrastructure and other assets in Africa, have attracted or have, as institutional investors, are already present in Africa. It's AMC, clearly, it's the Washington State Pension Fund and others. So how do we work with you to expand on what you've already done? It's kind of how do we expand that envelope? How do we go one step deeper? And then a third point that came across to me across a number of the conversation is that to access a large number of these institutional investors. They are consultants, gatekeepers, whatever you want to call them. So engaging with them and eventually also with trustees, etc., to kind of familiarize them with the African opportunities and get them to understand better what these opportunities are, and getting them to open up their risk appetite a bit and is something critical. Also in the same vein, clearly many institutional investors are based on benchmarks. We need to expand these benchmarks and getting other African countries in the core benchmarks. And I've mentioned the AFME Bloomberg Global African Bond Index that we're developing. That's just one such instrument, but I think expanding the African exposure of benchmarks is going to be extremely important. And finally, for some of those things, and unfortunately we didn't have ministers here today, for some of these things we'll need to work with governments, with central bank governors and financial sector regulators also to make these opportunities more attractive. But so, in summary, thank you all very much. For me, it's the beginning of a conversation, and I hope we can continue it and certainly meet again at the latest at our Africa Investment Forum in November of next year with some increased deal flow to speak about. So thank you very much.
Thank you very much. This roundtable is now closed. Thank you.
Thank you. Doing business in Africa. You can't afford to be without Africa Investor.